Hi, welcome back to this course on detecting financial frauds. In the past video, we have discussed about the profit and loss statement and understanding what are the possible ways to enhance the operating profitability of the company and how do we detect them. These are general terms. There may be many more creative methods out there, but ideally it will fall into the same categories, increasing the income, reducing the expenses. So the method or the modality of doing that or achieving that can be different, and we cannot cover all of those the the course because depends on the situation and how they are being carried out with the help of their business partners and the auditors. Now the next thing which we're going to discuss now is the balance sheet. So there are a lot of things that in the balance sheet companies can do in order to please the investors, in order to please the lenders, and also the general users of the company to show a very good financial health of the company. So let's look at the balance sheet and understand the different components. So the first component definitely is the cash and cash equivalents. Now this cash and cash equivalent is a very important aspect because the quick ratio and when the lenders are looking at the balance sheet, they look at what are the cash reserve that the company has, how many days the company can survive. So there is usually a ratio to calculate the cash ratio to the current liabilities and also the normal expenses to see how many days the company can survive, right? So usually you will be able to see them into the ratio analysis. So here is a quick ratio for the company, then the cash ratio, also cash ratio divided by the current liability. So here you can say the cash is enough to cover the 50% of the current liabilities. So and the other company L brand has 7.71, which is quite high, right, compared to the gap. In this case, the current ratio has dropped significantly. Cash ratio has dropped significantly. So, but to understand that why that has happened, you need to look at the cash flow. So once you look at the cash flow, you will see, okay, what is the main reason for dropping the cash. So you will see here first is the cash from operations. So cash from operations has definitely reduced, but it's not that significant. 1,700, 1,300, and 1,300. Now the next item you will look at is the cash from investing activities. So here you will see there is a quite a significant jump in the cash from investing activities. Means the company has acquired certain investments, which is 464 million. So because this is a short-term investment, it's okay to accept that because for the invest from the for the lenders, because the company can sell these short-term investments and generate the cash, right? Then there are the total cash is increase or decrease is given there. Cash and cash flow, restricted cash at the end is reducing. Cash and cash flow at the end is has reduced mainly because of the investments, right? So which is you can conclude from here. Now you will be able to see, okay, the total so the cash and cash flow statement is clear now because we are able to see that if there's a drop, the drop is coming mostly because of our investment. So which you can see here, the short-term investment has increased, right? Now the situation sometimes happen is when the cash flow is deteriorated. Normally the companies can take short-term bank overdraft or bank loan at the end of the year to show a very high cash amount and put them into the current liabilities, right? So maybe a long-term debt or into the current liabilities instead of reducing that bank overdraft from the cash and cash equivalent. So what will happen is immediately after the balance sheet date, normally in the first month or second month, they return the loans because nobody want to incur the interest. So what will happen is there will be a significant increase in the cash long-term debt immediately, and also the or the current liabilities because the bank will be increasing there will be an increase in the liabilities. Here you don't see that, but it can happen in the real world, where you are the company can classify a bank overdraft to show the increase into the cash and cash equivalents. So that is one way the cash can be manipulated. The inventory, as we have discussed earlier already, the valuation can increase. The actual inventory can be more than the ground stock to reduce the profitability, to increase the profitability and reduce the cost of goods sold. So the only way here ratio will be able to justify, to understand, is the cash inventory holding days and also the gross profit percentage. So if the gross profit percentage has increased too much or inventory holding days has increased too much, means there may be something wrong with the inventories. The other current assets usually should be remaining the same, because these are generally the advances or the deposits the company has made. If there is a significant jump, the auditors need to check. It may also be a place where the expenses are hidden. Then you have the total, then you have the property, plant and equipments. Here a lot of things are can be done by changing the accumulated depreciation method. So normally what the company is should be doing is calculate the uh, inventory accumulated depreciation. So here you can see the accumulated depreciation is 5,700 and 5,900. So what you can do basically is you can say, okay, let us put this into the another one. We just gonna calculate one ratio, right? So here is the total. So the depreciation in this year is about 5,962, and the depreciation in this year is about 5,700 and, sorry, 5,775. So the total fixed assets are actually 8,600 and 8,700, right? So what you can do in this case is usually you look at the depreciation rate. Is what is the depreciation rate? Depreciation rate, as you will see here, is reducing slightly, because obviously there may be a new asset that they have purchased, they might have purchased, or there may be they may have sold some assets, so which will be shown into the account in the schedule. So what will happen here is you will be able to see you should be able to calculate the average percentage of the depreciation to the fixed asset. If there is a significant difference between the depreciation percentage, it may indicate two things. One is there may be certain additions which has been done, on where the depreciation has not been charged, and the second is that the depreciation method itself might have changed. So then the valuation of the fixed assets may be stated, right, to improve the profitability of the company. So this is one way how you can check the quickly through the ratio analysis, the property, plant and equipment. The other method definitely is to go into the additions and check physically what is happening there, whether the company is using historical cost or valuation methods, fair value method. If they are using fair value method, when was the last time done, and is there any real significant real corroboration of the market values? Maybe the company, you may look at the cash return on equity, return on assets ratio, right? So if you look at the return on asset ratio, let me see if I have calculated that. Yeah, so here you will see, I think we should be able to see the return on the return on equity, not return on assets. But you can calculate the return on assets by calculating the uh, cash from operations. So you can calculate that. Let's calculate that quickly. Cash from return on. So this is the total return, total assets, the total value. So the net income or the EBITDA, you can see, is the common size income statement. We are not including the depreciation here, so we are calculating the operating income only, so that we So divide by that one and then one. So it's gonna be 15% and so the return on asset is also not that significantly different when you are inflating the assets valuation. Normally the return on asset for go for a toss, and you can always compare that with the other companies, other if they are also following the market value method, fair value method, or a normal historical method of presenting. So this is one way to calculate the other. Now there is normally a way to hide the expenses is putting into the other long-term assets. The company, the auditors need to really identify what are the current other long-term assets, as the amortization or depreciation is being charged on those assets or not, and are they really the long-term assets nature, or they may be a hiding place for the expenses, right? So that is the balance sheet, that is the asset part. Now the next video we're going to look at the liabilities part.